Kannan Chirgaonkar is head of India equities at UBS, and he's with us right now on the show. Anand, thank you very much for your time. Good morning, Prashant here. How do you rate the earnings? Yes, last week was the earnings heaviest week. It gets relatively light from now, although there are still some meaningfully large companies which are yet to report. But so far, how would you rate the season?
So I think it's been as per expectations, because our expectations itself were pretty muted when we started off on the earnings season. So we had projected about 0% growth or flat growth for the quarter, and the last we saw from about 23 out of 50 companies from the Nifty which had reported, the top line has been about minus 10%, whereas the bottom line has been plus 1 or plus 2%. So to that extent, I think on a muted expectation, the earnings growth has been in line. But what worries us is that the consensus expectations for earnings for the full year still remains pretty high, at about 15%. And the delivery so far in the first quarter has been minus 5%. The second quarter has been 1% plus or minus. So that leaves the second half expectations pretty high, at about 25%. Now, we don't think there is any chance that Nifty companies can deliver 25% growth for the next 2 quarters, which is where we are expecting about 8% growth for the full year. And therefore, we believe that the street will lower their earnings expectations from plus 15% down to about 8-9% for the full year, and this would happen over the next 2 quarters. So I think that's the context in which we should view the current quarter's earnings.
You think we'll get to 8-9% for the year, or it could be even lower?
Yeah, so currently our projection is 8%. We haven't really tweaked that after this quarter's earnings. Maybe we'll take a look at it once the earnings seasons are over. But I think the point I wanted to make was the expectations for the year from our side have been pretty tepid, but the street is still a bit aggressive, which is where I think the disconnect lies.
Yeah, no, that's fine. But I guess, more and more people that I speak to, at least on the show, they all kind of say the same thing, that the street is still very high and that needs to come lower. But, all of you make the street, right? So I'm assuming that it is slowly coming off. Not as fast as it should, but the earnings expectations are coming off. Anyway, Anand, what is the sense you're getting on the basic?
Correct. So by the time we started the earnings season.
Yeah, go on. Sorry, complete that point.
No, so on your point about the street having come down, so I think by the time the earnings season started, the street was at about 18% for the full year, and after the first quarter, it came down from 18% growth to 15%. So you're right in terms of the street actually coming off, but I think there is still a lot more scope for that to play out.
So revenues across the board are sluggish, and margins, especially for B2C companies, B2C type companies are being have been expanding, right? And it's not a new trend. We've seen this for the last couple of quarters as well. But I think one notable thing, and I don't know if you agree with this, is that at the gross margin level, there's a large improvement because of falling commodity and input prices. But it's translating to a lesser degree as far as EBITDA margins are concerned. Again, for all kinds of companies. Across sectors, but mostly B2C companies. Is that an assessment that you think is right? And what are the takeaways from that then?
Yeah, so I think that is understandable. So that is understandable because I guess what's happening at the background is that the consumption is actually slowing down. And what the companies would want to do is to sort of spend aggressively on advertising promotion to sort of make sure that the consumption remains and the revenue growth remains intact. So I think that is what is playing out from the company's side, and I guess they're doing the right things in trying to protect consumption and protect growth, but that is sort of affecting the EBITDA growth.
Competition more on, I mean, staples, for example, right? You're seeing a fair bit of aggression from relatively very large players who were not really considered real competition. Suddenly they're there and advertising heavily. So the incumbents have also got to advertise. And I think that is true for a majority of sectors. So even as growth is under pressure,
Correct.
competition and other disruption is only increasing.
Correct, but that is what we would expect in a slowing down environment in consumption. So I guess everybody tries to get aggressive and tries to get or retain market share and tries to get whatever little growth is floating around. So I think these are sort of expected in this kind of times.
Right, right. You know, I'll come back to earnings in a bit, but say consumer staples, right? I think most people say it's valuations are too expensive for the growth that you're getting through these names. But that's fine. But I want to ask you, do you think as more and more people get on the internet and more businesses move online, the entire segment kind of gets homogeneous, be it personal products or, you know, soaps or detergents. Take HUL as an example, right? I mean, do you think as these products are sold online and bought online increasingly, and it's happening at a pretty fast pace, the competitive moats that each of these businesses and each of these segments have, that actually goes down. So there is that threat as well, which I think isn't fully appreciated.
So I think currently what is happening is, or at least the way the street is looking at it is, I guess internet is a very small proportion of the sales for any of these large companies. And if you're talking about, say, any of these consumer staple names which have got brands, internet is being viewed as one more avenue or channel for sales for them. So to that extent, I guess Lever wouldn't mind if their soaps or detergents get sold on the net. So their moat, I don't think, gets impacted over there. But net what might happen is that the distribution edge gets diluted a bit simply because more and more companies and more products can get accessed on the net. So that's the real risk. But I guess it's too early to worry about that simply because the penetration is low. The sales on the net are a very small fraction of what these companies actually sell. The real worry for consumption, however, is the overall slowdown that we are seeing across various product categories. And I think that is the primary reason why we are sort of underweight consumer staples because the valuations still remain high, consumption slowdown is real, and the companies are forced to spend aggressively in terms of advertising and promotion to retain a market share as well as to show some growth on their numbers. So I think that's probably a bigger worry for consumer staples.
Okay, no, absolutely. I began with that preface that those are what you outlined are the given risks, right? But I guess we'll start to look at new risks as well. And although it could be actually small in reality, the new risks, the impact can be disproportionate, as we've seen many times in the past as well. Anyway, let's come to discretionaries, consumer discretionaries, Anand. So that's, I mean, Maruti, for example, if you just go by Maruti as an example, all seems well there. How would you rate the performance, earnings performance?
So I think we have been sort of underweight on two-wheelers part of the consumer discretionary because we think that's where the growth is at risk more than the four-wheelers. And this came out from one of our evidence lab surveys which we had done. We had tried to sort of estimate if the economy turns around and consumption were to come back, which are the areas in which the pent-up demand is really high. And it came about that two-wheelers does not really have much of a pent-up demand in the system. So we thought that it is an ideal candidate to sort of go underweight because even if the consumption were to pick up with the economy, maybe four-wheelers benefits a lot more because we've seen a lot more pent-up demand over there as compared to two-wheelers. And that is what we are seeing quarter after quarter when it comes to volume growth. So two-wheelers are sort of tepid, cars are sort of doing well. So that fits well into our thesis on consumer discretionary.
Okay, like the four-wheelers, cars basically, right? Okay. Any other segments there in the consumption space which you're bullish on?
Mm-hmm. So on the No, so if you were to call, extend more from the Evidence Lab survey which we had done on consumption, again, the takeaways which came about was that there isn't any rush among consumers to buy gold or jewelry or diamond-studded products. So to that extent, I guess that's the area in which we were sort of surprised that there isn't as much pent-up demand on that front as well. And the third one, if you could talk about property as some kind of a consumption. That was a third area in which we thought, or at least the survey showed that there isn't enough rush for people to buy property in the next 6 months. Although with a 2-year period, there's a lot of demand still pending over there. But in the immediate future, I think consumption has sort of slowed down and consumers sort of stepped away from buying, say, two-wheelers, buying property, and buying gold and gold-related products. So that was really the broad outcome of that consumption survey.
Yeah, although for very different reasons, right? I mean, all three things that you mentioned, two-wheelers, the reason why people aren't buying, I guess, is because there's no demand. I mean, in that sense, right? Property, I mean, obviously there is demand, we know that, but affordability is an issue. Gold, of course, I mean, could just be a function of how the asset itself has behaved over the last. I mean, people usually want to get in when the asset class is doing well. I just want to highlight the Cafe Coffee Day IPO, which has come to the market. It's 10 o'clock, which means you've got the first rates coming through. Anand, just 1 minute. I just wanted to highlight this, 7% lower from the issue price. So 305 is where that is. Nearly about 2 million shares on it, 26, 27 rupees lower. We'll keep this there so you can track the new listing as it progresses. But this is the first minute or so of Coffee Day in the market, secondary market. Anand, go on. Sorry, go on.
Yeah, so the point on discretionary consumption that we were trying to make was that there could be different reasons for different asset or consumption products why we're seeing slowdown. But the net result seems to be that the consumption slowdown is real and doesn't look like it could recover in the next 1 or 2 quarters. So I think that's where we remain underweight on consumer discretionaries, particularly two-wheelers as well as consumer staples.
Yeah. So I go back to my point. Are there any other things in consumption per se, in the overall consumption, and you can stretch the definition of consumption a bit if you want, that you like, that you're bullish on? Maybe for the price they're trading at or the business?
No, so I think we are positive on the four-wheelers or cars on passenger vehicle side. So that's the area, or niche two-wheelers wherein you could see a premiumization coming through from the standard two-wheelers to going towards niche or premium two-wheelers. So I think those are 1 or 2 areas which offer some relatively better performance or outlook. But net, I guess, given the valuations of the stocks and the sector and the growth outlook, we would rather be underweight.
Okay, fair enough. Banks and private banks, Anand? Most have reported, actually, I think all have reported. Now this week is heavy with public sector banks coming up with earnings.
Overweight on the... Yes, so we are positive on private banks or financials as a sector, but our preference clearly is for private banks, and within private banks, those which have a better book or asset quality. We think that the asset quality issues or worries are not yet over, and they may not remain restricted to PSU banks alone. So they could actually flow through some of the private banks, as we've seen in this quarter's earnings, and asset quality reported by 1 or 2 of those private banks. So the preference clearly is to remain with private banks which have more working capital oriented exposure or better book or better asset quality. I think that's where the sweet spot would lie among financials. Overall, we remain positive on that space.
Overweight on financials. Let's come to, so this is just banks, or are there NBFCs, any niche NBFC which you also like?
Yeah, so banks and NBFC, but I guess asset quality remains our primary concern. So when we look at stocks within that space, I guess we would like to restrict ourselves to names in which asset quality is clearly superior and would remain steady rather than deteriorate if the economy were to take a tumble.
Fair enough. Let's move to the infrastructure side. As the L&T results have shown, is there any reason to continue to hope for a revival in the near term?
No, so our sense is, we've been neutral on the industrial space, and we think that the expectations for industrial recovery were ahead of times, and that's what has been playing out over the last 2 quarters. So we think that it is going to take more than 2 quarters to sort of see the order flow starting to come up. And quarter after quarter, the results of industrial names, infra or cap goods, have been showing that the order flow isn't really picking up. So that remains our base case. We're neutral on that space. We think that we should wait a while before we see real signs of pickup in terms of either capex coming up, in terms of government or infrastructure, or in terms of corporate setting up more plants or expansions. Before all of that happens, I think it's too early to get into or get overweight on the industrial space. So we remain neutral on that.
I mean, L&T specifically, Anand, has UBS revised its target lower? I mean, earnings estimates and price target lower?
Yeah, so we've come out with research, but we wouldn't like to comment on stock specifics as we've discussed earlier.
Okay. But you said that it will take more than 2 quarters for resurgence as far as order intake, etc. is concerned. But what would change in 2 quarters, Anand? Why would it happen? I was asking the same question
so again,
6 months. 2
quarters
quarters back.
On the industrial side, again,
Yeah, go on. Sorry, there's a bit of a lead and lag between when I ask and when you hear the question and respond. But yeah, go on.
No, I think on the industrial side, the issue is the same, wherein the expectations have been far ahead of reality, as has been for the rest of the market. So we think that the expectations around industrials and cap goods for order book revival have been running ahead of expectations, and therefore even the current expectations, which have been partially lowered by the street, the asking rate for the next 2 quarters still remains pretty high. So I think by the time 1 more quarter goes by, those expectations will have to be revised lower again. And I think that's really the risk for industrial names. So that's why we're not really pushing these names aggressively, or we're not overweight. I think we need to allow this cycle to play out in terms of expectations downgrade from the street, and which would also reflect in possibly the stocks correcting. And that is where we would like to revisit these industrial names in a quarter or two.
Yeah. As far as infrastructure goes broadly, I mean, not just industrials, but overall infrastructure, is there any area you're bullish on?
No, I think so. We're positive on the road space, and I think that's the area in which we're seeing some progress. So I think that's the area in which our expectations still continue to be met by the companies in that space. And possibly that's the only corner in which we are overweight on the industrials or cap goods and infra space. So I guess the options are limited, but net, I guess roads is something which continue to meet our expectations.
I mean, so far what we've discussed, you like four-wheelers, you like private banks with better asset quality, and you like the roads segment specifically. The last when we chatted, you had said that in September, you had said that you like pharma, you're negative on IT. And you said that maybe for the 12+ month time horizon, one can start looking at metal mining names. You want to kind of reiterate those points and add something to them?
No, so I think on these No, on these sectors we still remain the same. So IT we still continue to be underweight. We think that there are structural changes which are playing out in the IT space, and I think that till those issues get sorted out, we think that the pricing in the IT could be under pressure, and therefore the margin expansion looks difficult. On the pharma space, some of those results have sort of disappointed in this quarter, but if you look at the management commentary, most of those are talking about new product launches and approvals which would come through, and therefore the second half clearly looks better. So we continue to remain overweight on pharma. On metals and mining, again, I guess a lot of price damage has been playing out in this year, and I think we are positive only on those companies in which there is going to be volume expansion, not really looking for price uptake. So that still remains our view.
Okay, fair enough. Any thoughts on what we're seeing on Cafe Coffee Day, Anand? Can you comment on it? Or maybe not in the company per se, but the business?
No, we don't cover this stock. Sorry, we don't cover this.
Okay. Do you have coverage on any of the aviation names? Airlines?
Sort of lukewarm on consumer discretionary. No, we don't cover those names.
Okay. All right. Fair enough. We'll leave it there. Anand, thank you very much. Great speaking with you. Appreciate you joining us this morning with that. Thank you indeed.